get in a market expert now to tell us how to approach the times to come. Rajat Rajgarhia of Motilal Oswal Securities is with us to talk about that. Hi Rajat, good morning and good to see you in on the show. We're just about 1 or 2 percentage points away from our all-time highs. What do you advise investors to do at this point in time? Because the rally has been so narrow. We've had a decade low in terms of retail participation. Is this the time to step in, or is this the time to just take profits and move out?
Hi, good morning. I think these levels of 61, 6200 of Nifty has been seen now many a times in the last few years. In fact, this year itself, this is the third time that we are seeing these levels. More important is that every time you are approaching these highs, the character of the market just keeps on changing. So some of the sectors would be trading at multi-year or lifetime highs, and within that some of the sectors would be trading at almost within their low price points of the last 2-3 years. It's very important right now to be a lot stock specific, because markets are just respecting wherever the earnings momentum is picking up. So this year, technology, healthcare, telecom, consumer, wherever the earnings growth has been double digit plus, technology in particular 30% plus earnings growth, those sectors have done well. So I think the basic framework of the market is that perhaps we saw the bottom being made into the August and September beginning, when we saw 53-5400 of Nifty, currency of 68, and from then the markets have again come back to the high end of their range. So they are likely to trade here. We just may see some election momentum in the next 1.5 months on the state level, which may push up the market little higher. But I think getting the stock right is very key to make an upside into this market right now.
Okay, so let's pick stocks in that case, Rajat. Well, first up, Larsen & Toubro. Numbers were in line, but expectations were already muted. At this point in time, will you go ahead and buy the stock?
Well, yes, because I think if you look at the environment, this environment is most challenging for companies in the capital goods space, because what we are talking about the investment climate being at almost like a decade low in India right now, and within that you have L&T, which is still growing their revenues at 10% in this quarter, having an order intake growth of 27%. I think this is how good companies, great companies adapt themselves, where they look at opportunities. They have looked at the export opportunities, some of the specific segments, still growing their numbers well. This quarter, of course, this year the numbers will be moderated because of some investments in the businesses like shipbuilding. But I think they have done very well in the kind of environment that we have in, and that's why investors remain positive. That's why you still see the valuations of the stock being at a significant premium to the capital good pack. That will remain. In fact, the only one stock that investors would continue to hold on in the capital good will be L&T.
Up to what price will you buy it?
Well, our target price for the stock is just above 1,000, so which itself is a 16-17% upside. And I think it's important to note here is that both the earnings and the target prices are being made at the lowest point in the cycle of the investment climate in the system. So at the lowest point, if you have a 16-17% upside, when the cycle turns up, we'll just keep on chasing that. So remain invested. Buy today also if you get the stock at these prices.
So would you not be worried about the company meeting its FY14 revenue guidance of around 15% or so? Because in the first half of the fiscal, it has managed just about an 8% growth. How are you expecting the second half to pan out for L&T?
Well, our numbers, and I think a lot of the street numbers are also modeling in numbers which are little lower than what the management guidance is. So while there is one way to look at it, that 15% guidance has to be met. I think in this kind of an environment, investors are very comfortable with a 10-11% kind of a growth, because we are talking about growth in a capital goods sector in a year when IIP is hardly crawling up above 0 to 1%. So I think 10-12% kind of a revenue growth is very commendable, because this year is the lowest year that we are seeing at both the IIP level and the capital goods cycle as a sector. So I think 10-12% is something which investors will be very comfortable with. 15% looks right now little optimistic, and that is the difference between what the company is guiding and what analysts are building right now.
Okay, Ultratech, numbers disappointed. Would you sell Ultratech today? Would you sell other cement stocks as well?
Well, we definitely were disappointed by Ultratech. We have lowered our estimates also. We have lowered our rating also, because we think that now, given that the stock has quickly come back to 2000 levels, the disappointment and the cost inflation which has come into their numbers at $140 EV per ton definitely leaves a very low return potential in the near to medium term. Just a while back, just some time back, we had upgraded ACC also, because I think somewhere in the cement cycle also we are right now quite close to the bottom, because cement is again a proxy to how the domestic economy has been behaving, and the last 4 quarters trailing has definitely been one of the low points of the domestic economy. So somewhere, you know, in this quarter, next quarter, we will see the cycle seeing bottom. Within that, I think the interesting part is to buy the companies where we'll see some volume growth and a lot of operating leverage. ACC would be our preferred name into this pack, so we would be recommending investors right now to focus on that. Ultratech, as I mentioned, we just downgraded to a neutral, so that's not on our buy list now.
Okay, since you do believe that this market will reward earnings momentum, Rajat, in the last 10-15 days from the heavyweights, we've had better than expected results from TCS, from Infosys, Reliance and Bajaj Auto. Between 4 of these stocks, or among 4 of these stocks, are there any in which you would put incremental money post numbers?
Well, yes, out of these 4 names, Infosys and Bajaj Auto would be the 2 names that I will like to put money in. Infosys is something where we have written enough in the last 6 months, more so after we saw some confidence being returned in investors amongst the top management. Well, I think if you look at this company 3 years back, they used to grow their top line at 15% plus. Margins used to be north of 30. Both in the last 3 years have changed, where they have been growing at single-digit growth, and margins, despite a currency appreciation of 40%, has been almost come down by 500 basis points. I think slowly they are reverting back to those two growth rates again. That in large caps, the most important difference is if you get the trend in the earnings changes right, because at the beginning of the trend in the earning changes, you need to buy into the stock and just sit tight. Infosys is one such name. Bajaj Auto, this was the first quarter where you started seeing growth being quite good. They of course will be a big beneficiary if currency remains at 60 plus. Their forwards would have been contracted at higher rates. Exports are doing well for them, and somewhere in the domestic business, I think this year you will see things bottoming out for them. Stock has almost remained ranged in this band for quite some time, and while it has seen some rally off late, I think both Infosys and Bajaj Auto look set to benefit from the currency depreciation and their own business model just reverting back to a normalized growth rates.
All right. On that optimistic note, we'll let you go. Thank you very much, Rajat, for joining us.